hook and promise. Imagine there's one quiet fund working steadily behind the scenes, building your retirement little by little, without you even thinking much about it. Sounds like magic, right? Well, it's not magic, but it is powerful. Today on the Capital Breakdown, we're uncovering the story of the ETF, the exchange-traded fund that's likely been a silent partner in your long-term investing journey. By the end of this episode, you'll understand how ETFs work, why they've become a favorite tool for building wealth over decades, and how compounding turns small, consistent investments into something meaningful. No jargon, no hype, just clear explanation so you can feel confident about the foundations of your financial future. The problem or confusion many people hear get tossed around but aren't quite sure what it means or why it matters. Maybe you think it's just another type of stock or a complicated product only pros use. Or perhaps you've dabbled in investing and felt overwhelmed by all the choices: individual stocks, mutual funds, bonds. Like a confusing buffet with too many dishes. This confusion can lead to hesitation, or worse, chasing quick wins with risky bets that feel more like gambling than investing. The reality is, most people want a steady, understandable way to grow their money over time without constantly watching the market or trying to pick winners. That's where understanding ETFs can simplify your financial life and help set realistic expectations. Core concept explains. So, what exactly is an ETF? Think of it as a big basket that holds lots of different investments, stocks, bonds, or other assets. Instead of buying one single stock, you're buying a small slice of that entire basket. Imagine you're at a farmer's market, and instead of buying just one type of fruit, you grab a mixed fruit basket that gives you a taste of apples, oranges, and bananas all at once. That's diversification, the idea of spreading your money across many pieces to reduce risk. ETFs trade like stocks on an exchange, so you can buy or sell shares during the day. They often track an index, like the S&P 500, which is like a scorecard of the biggest companies in the market. This setup makes ETFs a simple, cost-effective way to invest broadly without needing to pick individual winners. Core concept explained. Continued. The beauty of ETFs lies in their simplicity and flexibility. They act as a bridge between the stock market and your investment goals, letting you own a piece of a large market segment instantly. Because ETFs are usually passively managed, meaning they follow an index rather than trying to beat it, the fees tend to be lower than actively managed funds. Lower fees mean more of your money stays invested and working for you. And here's the kicker: by consistently adding to that ETF over years and decades, you harness the power of compounding. Compounding is like a snowball rolling downhill, gathering more snow as it goes, turning small beginnings into sizable wealth. Understanding this is key to appreciating why so many investors rely on ETFs for their retirement plans. How it actually works behind the scenes. ETFs involve several players working together. Fund providers create the ETF by assembling the basket of assets it will hold. Investors like you and me buy shares through brokers. Think of brokers as the marketplace facilitators, connecting buyers and sellers. Regulators oversee everything to keep markets fair and transparent. When you invest in an ETF, your money flows into that basket of assets, and the fund provider manages the holdings according to the chosen index. Unlike mutual funds, ETFs trade on exchanges, so you can buy or sell anytime during market hours, offering flexibility. However, there are small costs, such as expense ratios, annual fees, that cover management and operational expenses. These fees are usually low but important to keep in mind because they slightly reduce your returns over time. How it actually works. Continued. It's also worth noting that ETFs offer transparency. Most disclose their holdings daily, so you always know what you own inside the basket. This contrasts with some funds that report less frequently, which can leave investors in the dark. The liquidity of ETFs, how easily you can buy or sell them, varies depending on the size and popularity of the fund. But many of the broad market ETFs have high liquidity, making transactions smooth and efficient. Remember, though, that market prices fluctuate throughout the day based on supply and demand, and sometimes these prices can deviate slightly from the actual value of the underlying assets. This is normal, but it's part of the trading mechanics you should be aware of. Simple, concrete examples. Let's put this into a real-world context. Picture someone named Alex who decides to invest a fixed amount monthly into a broad stock market ETF. Each month, Alex buys a small portion of that basket, owning a tiny piece of hundreds of companies. Over years, those monthly contributions grow, and the dividends earned get reinvested, adding more shares. This steady approach smooths out market ups and downs and taps into the power of compounding. Now, contrast that with Jamie, who buys shares of a single speculative stock, hoping for a quick big gain.
Sales?
Jamie feels the emotional roller coaster of sharp price swings, sometimes doubting the decision during downturns. This example highlights how a diversified ETF can offer more stability and less emotional strain over the long haul. Simple, concrete examples, continued Alex's journey, shows the importance of consistency and patience. Even during market dips, continuing to add to the ETF means buying more shares at lower prices, a strategy sometimes called dollar cost averaging. Over time, this can lead to a smoother growth path. Jamie's experience, while potentially rewarding, carries higher risk due to concentration in one company and exposure to volatility. Both approaches involve risk, but understanding your comfort with that risk and your time horizon is crucial. These stories illustrate why many financial educators, including those here at the Capital Breakdown, emphasize diversified, long-term investing with tools like ETFs to build a solid foundation for retirement savings. Risks, traps, and common mistakes. While ETFs are powerful, they're not without risks or pitfalls. One common mistake is assuming all ETFs are the same. Some track broad markets, while others focus on narrow sectors or use leverage, which can multiply gains and losses. Leveraged ETFs in particular are complex and designed for short-term trading, not long-term holding, so they carry extra risk. Another trap is chasing hot sectors or trends through specialized ETFs without understanding the underlying risks or how they fit into your overall plan. Volatility, the ups and downs of market prices, can be unsettling, but it's a natural part of investing. Patience and realistic expectations about growth rates and time horizons are essential to avoid panic selling during downturns. Risks, traps, and common mistakes. Continued concentration. Risk is another factor to watch out for. Even within an ETF, if a few companies dominate the holdings, your portfolio might not be as diversified as it seems. Also, overtrading ETFs can lead to unnecessary transaction costs and tax consequences, eroding returns. Remember, investing is a marathon, not a sprint. Avoid the temptation to try to time the market or chase quick profits. Instead, focus on building a balanced approach that reflects your goals, risk tolerance, and timeline. Understanding these risks and maintaining a disciplined strategy helps you stay on track, especially when markets get bumpy. How to think about this tool when you zoom out to the big picture of your financial life. ETFs fit into a broader strategy. Before investing, it's wise to have a solid budget and an emergency fund to cover unexpected expenses. Think of this as your financial safety net. With those basics in place, ETFs can serve as a core building block for long-term goals like retirement. They complement other elements such as bonds, savings accounts, or even real estate, depending on your comfort level and objectives. Remember, no single tool is a silver bullet. Instead, think of ETFs as one reliable ingredient in a diversified recipe that balances growth potential and risk. Keeping your eyes on the horizon and aligning your investments with your personal goals helps create a roadmap you can stick to. How to think about this tool continued. It's also helpful to periodically review your portfolio to ensure it matches your evolving needs and risk tolerance. Life changes, and so can your investment mix. But it's important to avoid making impulsive moves based on short-term market noise. The capital breakdown encourages you to approach investing with curiosity and patience, continually learning and adapting. By treating ETFs as a long-term partner rather than a get-rich-quick scheme, you empower yourself to make more thoughtful decisions. And always remember, no matter how good a tool looks, your best ally is understanding the basics, staying consistent, and seeking trusted guidance when needed. Recap and educational disclaimer, alright? Let's wrap up. Today we learned that ETFs are like baskets holding lots of investments, giving you diversification and simplicity. We saw how regular contributions to broad ETFs tap into the power of compounding over time, building toward long-term goals like retirement. We also covered the risks, like volatility, concentration, and the dangers of chasing leveraged or niche funds, and why patience and realistic expectations are key. Finally, we placed ETFs in the wider context of financial planning, reminding you to keep budgeting, save an emergency fund, and align your investments with your goals. As always, this episode is for educational purposes only and not personalized financial advice. Make sure to do your own research and consider consulting a qualified professional when making investment decisions. Thanks for tuning into the Capital Breakdown. Stay curious, stay steady, and keep breaking down the capital. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.